And you have to know that you're in a race. No, you have to take care of yourself and know when to sprint, because sometimes you really have to sprint. But if you sprint forever, you die, right? You have to win the marathon, keep your pace.
Hello, this is Shawn Budde of Ensemble X, and this is the Ensemble X Exchange podcast. Today I'm talking with Fernando Gómez Arriola of Nexu about how he and his co-founder started and pivoted their business. Fernando, he goes by Fer, was born and raised in Mexico City, and his childhood love for math led him to study actuarial sciences at LATAM and then his MBA at Wharton. Fer is now a co-founder of Nexu, a platform tailored for car dealerships in Mexico. Through AI and automation, Nexu offers immediate and flexible car financing options, creating a 100% digital and personalized experience. Fer is currently responsible for the areas of risk and credit assessment, finance, and HR. Prior to starting Nexu, Fer worked as an actuarial scientist at New York Life Insurance Company, as a consultant to the Boston Consulting Group, and led international growth and biz dev at Shopify. Thanks for joining us today.
Happy to be here, Shawn.
So, Fer, I think I first came into the Nexu offices, probably 2 or 3 years ago. As memorable as you and your co-founder Abden were, what really stuck with me was the power pole outside the window with 50, 60 wires coming off of it. On every visit, I checked in on the power pole, and on the last visit, the power pole was no more. Tell us what happened to the power pole.
Yeah, it's 50, 60 to say a number. I think there are like hundreds of cables. And I remember you always told us that it was what Mexico or Latin America like kind of met to you in a metaphor, like the big opportunities that exist to make things better. And yeah, I think each time you came to the office, probably like every 6 months or a year, you could see there were more cables. And suddenly, like a Sunday, one car crashed into the power pole. So the power pole was kind of bending and falling apart. But you had all these cable lines going through other buildings to this one, and it simply could not be removed. So they brought the best engineers from MIT and around the world to fix this very complex issue. And it was so complex that they kind of had to cut the power pole by the middle. It was a concrete power pole. They didn't know which cables worked and which ones didn't. So the easiest thing they found was leaving all those kind of lines, and they put another power pole by the side and kind of attached all these wires to the new one. So yeah, they didn't fix the problem from its roots, unfortunately.
Right. They kept the pole from falling down. So we were doing, I think, a monthly credit review in your office while this was occurring, literally right outside the window. It was tough to focus in that meeting if you were facing the window. What amused me about it is it just felt so much like technical debt, to maybe stretch a metaphor here, is that it's like, yeah, we just don't have time to clean this up. Half those lines are probably dead at this point in time, but they just lifted and shifted over onto the new concrete pole, and they'll deal with it another day or more likely not deal with it ever at all, I suppose. So to dive in, you and Abden met at Wharton. How'd you decide that you were going to start a business together?
I think it was good. We were friends before even thinking about like starting a business together. Given our background, we both knew that we wanted to come back to our countries, to Latin America, and give back. Abden grew up close to the Amazon in a small town. And I grew up also being lucky that my mom ran a nonprofit that worked with indigenous communities. So since I was very little, I grew very close to poverty, and I've done as well. So I think that kind of marked us. And for us, it was a great opportunity going to the US to study our MBAs at Wharton. Of course, it was easy to stay and work in banking or consulting in a startup, big tech company. I remember back in 2013, 14, Amazon was recruiting a lot of MBA students, and many of our friends went there. And it was very sexy, like going to Amazon or an investment bank or a private equity fund. We knew we wanted to give back, and it's very little of us that had the chance to study abroad, and we kind of knew it. we're lucky enough that we have been touched by financial services before in Latin America, working with banks, small financial institutions, and we could see firsthand like the big opportunities that existed for improve lives of people. So many people are underserved or not served at all, and big lack of technology in all the processes and of traditional players. So it was like in our summer internship, Abdon came to work for a financial institution in Mexico, and I worked at Shopify in Ottawa. And for me, was the first startup technology company experience, and I said like, this is so amazing, I want to do something like this, but back in Mexico. And that was my moment where I really decided that I wanted to do something. For me, it was mind-blowing that there were developers at Shopify at 11 at night on a Saturday or a Friday, and they were working and playing games, and it was like how do you build that culture, which is so important? And that's where like it was very serendipitous that we ended going for a semester to SF because we wanted to start a company, and that was a program within Wharton. And I ended up living with Abdon. And that's where I found out that he wanted to start a company. I wanted as well. And somehow we started working in the same problem and solution.
That's interesting. Did you decide you wanted to start a business together and then find the problem? Or were you kind of already aware that there was an issue and that that's an issue you wanted to solve?
It was a little bit more that we knew there was a big opportunity in financial services in general. And then we were strategic on where was the biggest need, where could we make the most impact, and what things were happening in the world that we could apply to Mexico.
Yep.
We remember very well, it was the time of all these marketplaces. We were in SF 2013. So imagine like besides Uber and Airbnb, that were like the hot startups back then. If you wanted to like not use your car and go to a supermarket, you were just grabbing anyone's cars and go to a supermarket. Or if you wanted to like park your car somewhere, there was this app to park use someone's garage for parking. And so we said like, okay, this marketplace business model kind of super cool. Why don't we start a marketplace for loans, starting with auto loans? We thought it was something relevant. So many customers want to buy their cars with credit in Mexico and cannot get any alternative, lack of technology. And we said like, okay, we could be that marketplace and help the market, help people get their cars faster and get the best possible loan or lease they can have.
Yeah. So as you mentioned, you started as a marketplace, but you're now a lender. How long did it take you to decide, I guess, to make that transition, and why?
Yeah, it's very hard as a founder to know when you really have product market fit, right? Because you never know if you're pushing enough, if you're like doing things right or wrong. You kind of go for it and keep doing and iterating, and until you have to step back a little bit and say, okay, am I the issue? Is the team the issue? Is the partnership the issue? Or we're not approaching the problem in the right way? And what we found out, and it's easy to look at it now from the future, but what we know now is that probably marketplaces work for more mature markets, as in the US or Europe, where you can find a spectrum of lenders for people that want to buy anything or get a loan in any asset class. But in Mexico, it happened that banks, even though they didn't tell us right away that they only want the super prime customers, they actually only want the super prime customers, right? And there's this big opportunity, and we got all these customers that didn't get an alternative, and we could not send them anywhere. So kind of the marketplace was not balanced. We had the customers, but we didn't have the financial institutions.
Right, didn't have the supply.
Right? And it took us around 3 years. In the meantime, we did so many things. Like we created an awesome product for Uber drivers that wanted to own their cars. We grew a lot in creating that product with banks for them. Eventually, like it didn't work out because, like default rates were so high and banks were shutting down this product. And around 2018, it's when we started lending.
Got it. And so when you started and you were doing the marketplace approach, Fintech was not per se a thing in Mexico or really most of Latin America. I think Nubank probably started around then, but nobody had heard of them at that point. How did you raise money for a fintech in Mexico? And how does that compare to kind of the reception you get today when you go out to raise money?
Yeah, it was it was tough. The word didn't exist. No, it was like I'm doing finance or financial services. And there were very, very few, now you could count them with your hand, funds, like VC funds that would invest in companies. And they typically would invest small checks, but in later stage companies. So you had to prove a lot,
Yep.
have revenues, even like some of them told you, oh, which are your EBITDA margins? So it's like, okay, if you're early on and you already have net income, positive net income, probably you don't need to raise any venture money, or you're not building like a platform or anything. You don't have to hire a product and develop a team and developers. So you had to go practically to other entrepreneurs, like kind of angels, to raise not much. That's what we did. You had to be super lean, pay yourself a little, very little, have people out of college running things, improvising a lot. It takes a while, but I think that is tough, but at the end, it's also good because you're lean. You get involved in every single aspect of the company. And eventually you can get out of that circle. You become profitable. You keep growing. You build a business without like throwing money at it.
Yeah.
For the long run, it's something good. It's not the only approach, but it's one of many.
Yeah, I talked to a guy probably a decade ago who had like a killer startup. It was very buzzy, and then it just kind of disappeared. And I'm like, what happened? He's like, we raised too much money. He's like, and then we started to chase 5 different things. We lost focus. We bought nice office space. And so there is something to be said for getting by with less. And it does create a certain culture. Okay, so you're making this transition from marketplace to lending. It's a pretty different business, and the risks are obviously very different. Did you have to get new investors to do that? I mean, how did you get the capital first off to lend? And then, how do you start doing something when you don't have the data and the history to work with?
Yes, it was an interesting and tough transition. We practically didn't have any equity left in the company. We knew all the funds, the very few funds that existed from in Mexico, and they were like either didn't like the business model or the team or anything or us. And still the US VC funds were early, like a little bit later they started investing into LATAM companies and Mexican companies. So we had practically to start. We didn't dilute ourselves too much before, and that was good given we were very lean and cautious on terms and everything. And we started and we went through Y Combinator. We've been around for a few years, but it was like starting, no? And then you go through Y Combinator. Then that gives you access to a bunch of angel investors and individuals that like very early stage companies. And the next year we raised our Series A. So, but you get that validation point, no, having like YC and other good angel investors. And if you were growing and the company is healthy and you were doing well, then you start attracting that base of US VCs.
Yeah. So other than the validation, what did you get from Y Combinator? What helped you in that process?
Yeah, I think that mentality of helping each other, growing fast, iterating fast, testing things was good. Something we had from before. It was not like starting from scratch. No, we had data of the loans we originated for banks and financial institutions. So that became the data we use to build our first credit models. It was not like starting, and we were lenders for banks, right? We were like the originator for banks before, so we knew their credit policies. So it was a mix of, okay, these are their credit policies. We have this data. How do we extrapolate whatever the regressions we have into serving more customers without doing something very risky?
Right. I can see how that could give you confidence. How did that give a debt facility confidence, or did you have to lend off of equity for the first year or so?
So first we were doing this like small private securitizations. We would go to anyone we knew from BCG, from family, friends, random people like family offices. And we would say, okay, if you invest 500K into Nexu at this interest rate, we will buy, say, 30 cars with that money,
Yep.
right? We'll give 30 loans and that will be your collateral, right? So we structured, if we gave like 48-month loans, we would amortize with them at 48 months. We would match the term of those loans. And some people gave us 200K. Some other people gave us 30K, not for one or two cars. So we were managing all these people that gave us loans to start lending.
Wow.
We did that like for a year and a half to grow the portfolio because, if there were few venture capital funds in Mexico at that time, debt funds, there were even less and they were very, very traditional. It was more like a working capital approach of loan, like for a corporation rather than for a facility. And banks that knew how to structure this, and they would start at very big facilities. And you had to be like audited for 3 years and have like a master trust and have a rating agency, like things that happen way ahead in time. So we did that. Then we started getting after with that experience some loans from some local financial institutions and from venture debt funds in the US that were expensive, but it helped us grow the portfolio. We had to be super disciplined in this period of time. And it was like 4 years, more or less, 3-4 years, now 2018 to 2022, being lean, making sure we originate well. At the same time, you're winning at the car dealerships. Didn't tell you, no, but Nexu is B2B2C platform for car dealerships. So we originate via car dealerships in Mexico, the loans and leases we give to our customers. So after all of this, in 2022, we became profitable. We already had audited financials. And then like bigger lenders start looking at you.
Yeah.
So it was like building things take time.
Yeah, people want to see performance history. I mean, I think that's, the challenge here is in the lending business, in the US, you're probably going to start at 15 to 20% interest rate you're going to pay in your facility. If things go well, you'll get it down under 10. Yeah, it takes a while to get over that hump to the place where the facility is large enough and you've demonstrated enough behavior for them to trust you. So why don't you talk a little bit about, you started with the credit policy by kind of extrapolating out from, what the banks were doing on your platform. How has it evolved over time? And what did you learn from those early days that maybe was wrong in terms of the credit policy or that actually was right and you kind of got lucky that you maybe guessed?
We try to be consistent and not changing too many things at the same time. You have to build data, right? So the thing with auto loans is that you don't get that many defaults too early, right? And you guys are the experts, but you probably need like 200-300 defaults in order to start thinking on having enough data to build a model, right? So we didn't have that. We had the information from banks, but probably not that many defaults. So we parted from that, and then we tried to do some proxies on defaults. We didn't have defaults, but when people pay late or they are...
Yep.
We had all these scoring systems of how good or bad a customer is, which we call the defaultiness score, right? So if you were messaging a customer for collections and they didn't answer back, that was minus points, even though they could pay afterwards.
Yep.
Or if they use bad words or things like that, right? So we had all this score, and based on that information, of course, if you were a little bit late or if you default, that would be the most extreme. That would be like a 1 default, right? But we had all this range, and based on that, we started like fine-tuning our models until in time we started having more data. So we did that, and probably we left that around a year. And said like, okay, does this still work? Do we have to calibrate a little bit? Until more recently, we have a bigger portfolio, more data, and we started building our machine learning models.
Yeah.
And with all your experience and everything, it has been like a very fun and interesting process.
Good. You mentioned one thing that I really liked, which is, leaving things in place for a while and not changing them all the time. I think we've worked with several startups who see their advantage as, we're really nimble. And as a result, they're changing. I mean, we worked with one that was changing policy every week. And so you'd go back and try and do an analysis and you're like, well, that week we didn't do any employment verification, or that week we doubled our price. Yeah, you really couldn't analyze anything. And so the nimbleness was definitely costing them a lot more than it was gaining them, I think, in terms of flexibility. So you have, relative to other organizations we've worked with, a pretty small team, a very small team on this. And in a way that probably also brings some discipline, which is you don't have 30 people trying to figure out how they're going to do something valuable this week. You've got I don't know how many you count, but I'd say 2 or 3 who are really full-time devoted to this. All right. So you referenced future fair, which is now. So if current fair, future fair, whatever you want to call them, is talking to 10 years ago fair, what do you have to tell yourself? Would you do it all again? What would you do better? What would you not do?
Yeah, I could probably tell you so many anecdotes and tell to myself so many things. The fair of 10 years ago. The most important is just do it, right? I think people get more regrets of the things that you do not do than the ones that you do, even if they fail, right? At least you try, and that's super important. And I remember we started working 10 years ago out of the basement of my mom's house, Ablon and then we become, although we were like 5 people before we moved. And we had these signs, like these little like paper and pen, like quote that we liked. Ablon had some, I had some. And one of mine was like, never fear, or do not fear, or something like that. And I think that's important, no? Like when you're starting a company and you're young, you're naive. And it's just because of that. If you want and question everybody if you could do the things you do, and they will probably tell you that you can't. It's that naiveness, that improvisation that helps you and drives you, and not fearing. I think it's very important. That's one. So I would encourage myself. You'll be happy and you'll enjoy the process. And that takes me probably to the next one, no? That enjoying the process and the moment. It's super important to enjoy every part of a process. Like you're super early and you're doing all the scrappy things and you have to do so many things yourself. Enjoy that part. If you're always looking forward to when you're not doing that part, or when you have money, or when you have a bigger team, and where you have a head of risk, there will always be something. I would tell myself that, like, enjoy the process and the moment, and then you'll remember those moments where you were in the basement and you didn't have money and you had to like go to investors to get a loan for 2 cars, and you laugh about that compared to the point where you are. So the third is that you have to take care of yourself. And you have to know that you're in a race. You have to be fast. It's a long moment. Probably something you do not expect when you're starting a company is that it's going to take many years. It's like another work or position in any company. I might stay here for 2-3 years and then let's see what's next. But when you run a company, it's probably going to take 10, 15, 20 years. And that's a lot of time. So you have to take care of yourself and know when to sprint, because sometimes you really have to sprint. But if you sprint forever, you die, right? You have to win the marathon, keep your pace, and eat healthy, and do the things you really love. Like I love mountain biking, or I love traveling. So it's not like, okay, I won't travel for 20 years. And then when I do this and this and this, I'll travel. Probably you'll never have enough time. So take care of yourself and prioritize better. Prioritizing is one of the toughest things for anyone. And how to prioritize work with life, with family, with friends, with exercise, with everything. And you have to be really smart at it. And probably the last that I would tell to myself is it's better to be poor than with bad investors, right? It's 10 times better. Many people say like there's no bad money, or the word money is the one you do not have, or things like that. I think completely the opposite. If you don't find your partners and investors that are aligned with you for the very long run, aligned with the vision of the company, where do you want to go, that do not trust you, it's 10 times better to make changes, restructure the company, whatever you need to do. But it's easy to take that money, but in the long run, it's worse. The temptation is very hard when you need the money not to take it. But if you have like a gut feeling that you should not do it, you should not do it.
Yeah, it's a really great point. I mean, you're going to have some rough times. We've talked about this in the context of bank partners in the US. If you have a bank partner that you're not aligned with, you can get sideways and things can be really, really rough. And the same applies to investors. That's a great one. The taking care of yourself, I think, is a big deal. And we kind of seem to be in a phase where we're glorifying people who are working, grinding, and I'm working 7 days a week, 12 hours a day. That may work for some people. One of the things I became very aware of when I was at Capital One and managing pretty large teams is that there were things that created energy for me and things that consumed energy. And if I didn't keep those things in balance, I got cranky and got bad outcomes. And so there were probably some things that theoretically weren't a good use of my time, but they did help create energy. And that allowed me to, expend that energy in other places where I didn't enjoy it as much. Well, that's a great set of lessons. So one last question. I always say insurance is just credit in reverse. You collect the money up front and you give it out in the back end. You studied actuarial science. So tell me, what are the differences between getting the money up front in insurance and giving the money out up front in credit?
I only worked for a year or so in insurance out of college, and I really liked it. I think there's a big opportunity for insurance products in Mexico and in the world in general, and doing things better. At the moment when I went to consulting and then working at Nexu, I said, why did I really study this? But I think it gave me the structure, the statistical. I don't know how many courses in statistics I took in college, but probably around 12 or 13, which are a lot. It has really helped me. Sometimes it's like defaults, or sometimes it's people like crashing or a hurricane coming, but the way you approach risk is kind of similar, and the models you build are kind of similar. So sometimes people say I never used the things of college or undergrad in my life. And I use them a lot. So it's at least rewarding knowing it helped me. But yes, I agree with you. I believe it's quite similar.
Awesome. Well, thanks. It's been great to hear about the journey for you and Abden. You guys have been a lot of fun to work with, and I'm super optimistic about where Nexu is headed. So thanks for joining us and telling us that story today. And for everybody else, you can follow Ensemble X and Fernando Gómez Arriola on LinkedIn. I'm not even going to try to spell that for you, but you'll find them. The company is Nexu, Nexu. You can also visit us at ensemblex.com. You can find the Ensemble X Exchange podcast on all major platforms. Fernando, thank you for joining us.
My pleasure, Shawn.
And again, thank you for listening.